Here is the strange thing about a health savings account. It is not powerful because it earns a special investment return. Depending on the provider, it can hold cash and may offer investment options similar to other accounts. The power comes from the tax path. In a normal account, $1 usually gets taxed when it enters, or when it grows, or when it leaves. In an HSA, if the rules are met, the same dollar can enter before federal income tax, grow without annual tax, and leave tax-free for qualified medical expenses. And if the contribution is made through a cafeteria plan payroll election, it can also avoid Social Security and Medicare taxes. That is why the HSA is often called triple tax advantaged. But the honest version is more interesting. The HSA is not magic. It is conditional math. In this episode, we are going to model the contribution, the growth, the withdrawal, and the medical expense scenarios, and then show exactly where the advantage breaks. First, an HSA is not the same thing as a flexible spending account. A health FSA often has a use it or lose it structure, though some plans allow a grace period or limited carryover. An HSA is an account owned by the individual. The money can remain in the account from year to year. The account is portable if you change employers, and the assets can earn interest or be invested depending on the provider and account rules. But you cannot contribute just because you want one. To qualify, you generally need coverage under an HSA-eligible high-deductible health plan. You also cannot have disqualifying other health coverage, cannot be enrolled in Medicare, and cannot be claimed as someone else's dependent. Starting in 2026, federal law also expands eligibility in some edge cases, including certain bronze or catastrophic individual market plans and some direct primary care arrangements. This matters because the HSA advantage begins with eligibility, not with investing skill. For 2026, the federal HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. People age 55 or older can add a $1,000 catch-up contribution. Employer contributions count toward those same annual limits, so the employee's remaining room can be smaller. On the insurance side, an HSA-eligible high-deductible plan must have at least a $1,700 deductible for self-only coverage or $3,400 for family coverage. But the out-of-pocket maximum can be much larger, $8,500 for self-only coverage and $17,000 for family coverage. That gap is important. The HSA contribution limit is not the same thing as full protection from medical bills. In the self-only case, the legal out-of-pocket maximum can exceed the HSA contribution limit by $4,100. In the family case, the gap is $8,250. Now, compare the tax gates. A Roth account is usually after tax going in, tax-free on qualified withdrawals. A traditional retirement account is usually pre-tax going in, but taxed when it comes out. A taxable brokerage account can be after tax going in and taxed again on dividends, interest, or realized gains. The HSA is different when the withdrawal is for qualified medical expenses. Contributions can be deductible or excluded from income. Earnings inside the account are not taxed while held in the HSA. And qualified medical distributions are tax-free. One more detail. If the HSA contribution is made through a salary reduction arrangement under an employer cafeteria plan, it can also be excluded from employee payroll taxes. A direct personal contribution may still get the federal income tax deduction, but it generally does not recover employee FICA taxes already withheld. Let's put numbers on it. Use the 2026 self-only HSA limit, $4,400. Assume the employer contributes $0, so the worker elects the full $4,400 through a cafeteria plan payroll contribution. Suppose the worker is in a 24% federal marginal bracket. Suppose that contribution also avoids the employee side of FICA, 6.2% Social Security plus 1.45% Medicare, or 7.65% total. This assumes wages are below the Social Security wage base and no additional Medicare tax applies. Under those assumptions, the immediate tax saving is 4,400 times 31.65%, which equals $1,392.60. So the paycheck cost of putting $4,400 into the HSA is not $4,400. It is $3,007.40. That is the first reason the HSA comparison is unusual. It can put more gross money into the market for the same reduction in take-home pay. Now let the money grow for 30 years at a hypothetical 7% annual return. This is not a forecast. It is just a clean compounding input. The HSA balance from one $4,400 contribution becomes $33,494. If that withdrawal is matched to qualified medical expenses, the full amount can come out tax-free. A traditional account funded with the same $4,400 gross dollars also becomes $33,494 before tax. But if the withdrawal is taxed at 24%, the spendable amount is $25,155. A Roth account can also produce tax-free qualified withdrawals, but in this same gross wage example, the Roth contribution is made after the 31.65% combined tax, so only $3,007.40 enters the account. After 30 years at 7%, that becomes $22,193. A simplified taxable account with the same after-tax starting amount and a 15% terminal capital gains tax ends near $19,910. The HSA does not win because the market return is different. It wins because fewer tax gates touch the same return. But if the HSA is used for non-medical spending after age 65, the extra 20% tax disappears, yet ordinary income tax still applies, making it look much more like a traditional retirement account. A one-time contribution is only the simplest case. If someone contributed $4,400 per year for 30 years, holding the limit constant just for modeling clarity, the future value at 7% would be about $415,627. At 5%, it would be about $292,331. At 9%, about $599,753. For family coverage, using the 2026 limit of $8,750 per year, the same 7% and 30-year model reaches about $826,532. These numbers are not promises. Real contribution limits change. Investments are volatile, people change jobs and health plans, and many HSA balances are spent along the way. But the visualization shows the mechanism. A tax-free growth environment becomes more valuable as time and contribution frequency increase. The exit door is qualified medical spending. IRS rules say tax-free HSA distributions generally apply to qualified medical expenses incurred after the HSA is established, and records must show the expense was qualified, not reimbursed elsewhere, and not also deducted as an itemized medical expense. In retirement, that can include many medical bills and Medicare premiums, but not Medigap premiums. This is why the HSA can be powerful in retirement. Medical spending is not a tiny category. EBRI's 2026 analysis found that a couple enrolled in Medigap with average premiums may need $267,000 for a 50% chance of covering retirement health expenses and $405,000 for a 90% chance. In a high prescription drug scenario, the target can be $469,000. Those estimates do not include long-term care expenses or costs Medicare generally does not cover, such as dental and vision care. The point is not that every household will spend the same amount. The point is that many households will have enough qualified medical expenses for an HSA balance to have a real tax-free use case. There is also a strategy people call the shoebox method. Pay current medical bills out of pocket, save the receipts, let the HSA compound, and reimburse yourself later. IRS Notice 2450 says a beneficiary may defer HSA distributions to later tax years for qualified medical expenses incurred after the HSA was established, as long as records are sufficient. But the honest math is smaller than the hype. Suppose you have a $1,500 qualified medical bill today. If you pay it from the HSA immediately, only $2,900 of the $4,400 contribution stays invested. At 7% for 30 years, that grows to about $22,076. If you pay the $1,500 out of pocket and keep the whole HSA invested, it grows to $33,494. That looks like an $11,418 difference. But that is not the full advantage, because the out-of-pocket cash also had an opportunity cost. If that same $1,500 had been invested in a taxable account for 30 years at 7% and then faced a 15% tax on the gain, it would end around $9,931. So the incremental tax advantage in this simplified model is closer to $1,088. Still useful, but not free. It requires cash flow, discipline, clean records, and the ability to handle medical bills without draining the HSA early. Now, the reality check. First, an HSA requires an HSA-eligible high-deductible plan, and the insurance risk is real. KFF reported that in 2025, among covered workers enrolled in employer-sponsored HSA-qualified HDHPs, the average single deductible was $2,578, and the average aggregate family deductible was $4,132. The average employer HSA contribution was $690 for single coverage and $1,296 for family coverage, but 14 to 15% of those covered workers received no employer HSA contribution. Second, not everyone can benefit equally. BLS, March 2024. Data show HSA access in private industry was 20% for workers in the lowest wage quartile versus 62% for workers in the highest wage quartile. Third, many HSAs are not fully invested. EBRI found only 15% of account holders invested HSA assets outside cash in 2023. Fourth, fees and investment thresholds can reduce the advantage. Fifth, state tax treatment can differ. California, for example, does not conform to federal HSA rules. And finally, non-medical withdrawals before age 65 can be harsh. At a 24% federal bracket, a $10,000 non-qualified withdrawal before age 65 can lose $2,400 to income tax plus $2,000 to the additional tax, leaving $5,600 before any state tax. That is why the HSA is not a universal recommendation. It is a conditional structure. So the cleanest way to understand an HSA is not as a secret investment. It is a tax gate framework. A traditional account can be powerful. A Roth can be powerful. A taxable account can be flexible. But an HSA used correctly for qualified medical expenses can remove more tax gates than any of them. The result is not higher return from the market. It is higher after-tax medical purchasing power from the same return. The catch is that every part of the sentence matters. Eligible high-deductible plan, qualified medical expense, record-keeping, cash flow, fees, state tax rules, and withdrawal purpose. Used correctly, the HSA can be more powerful than a normal retirement account. Used carelessly, it is just a high-deductible plan with paperwork and penalties. The math is simple. The conditions are where the story lives.